Hi, this is Vinney Chopra. Thank you so much for deciding to purchase this deal analyzer. Even if you are a brand new investor or a savvy one, you will find this tool very, very helpful. It has taken me about 10 years to perfect it, and I'll be explaining this in this video how to use it correctly. Also, please be sure when you find a deal, it's a great one, but by deal analyzing and finding out all the different ratios and numbers, it will crush it for you. I have been able to purchase over $200 million in just two and a half years of real estate by utilizing this tool. Let's make it really great. And I hope you really enjoy the video that you're going to be showing. And thanks for investing in yourself. This will really bring you to a new junction in time where you will get to a faster track to analyzing the deal and also be able to present it to your investors in a timely way. Take care.
Now, what I wanted to do was kind of talk about a little bit about the blank underwriting template a little bit, and I'll be putting more stuff into it. Thanks for taking advantage of this dynamic, very thorough tool to analyze the multifamily commercial assets, and then steps 1, 2, 3, 4, 5. Then this is where it all starts. Elijah and Max, we start with the underwriting with the unit from the rent roll. We get it from the sponsor. I mean, from the broker, let's say, or from the seller, and we start putting this information, just these three things, and rest is all calculated automatically, except for the market rent. We put the market rent after we know what the monthly rent is. Monthly rent is actually current scheduled rent. So just like there is some these things pop up, I'm going to do that always. Look at that. I mean, we've been using it for a long time. December to instead.
Yeah.
So we'll change
Mm.
some dates and times and whatever. So this is where it starts, goes into this blank underwriting. It starts from here. All these numbers, well, only the first number gets populated, not rest of them. We do rest and we'll do it in a couple of minutes here. Assumptions. The exciting part is that we are able to really assume all different things, all different factors, and they are intertwined all through these worksheets, as you see at the bottom. Actually, I got this from my mentor, underwriting. That's the only page I got 10 years back, paid a lot of money. My gosh, we paid about 165,000 to take us
Wow.
and our
Oh,
team.
wow.
Yeah, so this template is pretty expensive. And then we added over the years with my team and myself lots and lots of new things. I'm a systems guy. So I wanted to put together a format so that I could just clip and put it in the brochure for the investors. That was my main thinking. What's the end result, right? So that's why we kept on designing and I kept on adding and all that. Now, 5 year projection was the very big heart of the whole operation to be able to see how will this asset perform in the next 5 years, because we have fiduciary responsibility to the investors, right, in syndication world. So we want to be conservative. We want to be totally looking into all the right ratios. And not, then we decided to just do another segment, which is all correlated, and we are able to change the rent growth by each year, per month, vacancy, concessions, loss to lease, non-revenue units, utilities bill back. First, we used to do it just by percentage. Okay, for the next 5 years, it's going to be, 5% or 3%. But then we said, no, 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 no. Each year, we need to do it differently, because each year the area, the market, and the market comparisons will dictate how and where we go. So all these things kind of amount into this very dynamic worksheet. So these two are the big things. This one, then this one, and this one. That's the heart of operation. And then equity return on resale. So we wanted to put together something, okay, in fifth year, what will it bring? and then how would it go about? What percentages can be changed? For every single thing is changeable. So that's the best part about it. Then it puts together everything in simple terms, very simple for the our investors to see and so forth. As you can see, we've been using it last 5-7 years, and I need to maybe change some of those dates and all. But there we go. Acquisition expenses. Oh, this is a huge one. The syndication attorney says, okay, where is the money going now? But you're raising so much money, where is it going? And then the partner distribution. This I decided about 6 years back to share the pie that our general partners make with our partners, members of the manager LLC. So that's the other part over there. Okay, this you saw the skeleton. I would like to then go to a property. Not this one. Well, let me just talk about this one. Creop is a beautiful company, commercial real estate online publisher. My syndication attorney, Kim Taylor, told me about them, and now I know the owner, and both Catherine and John are awesome, and they work for me, and they work for other people too. But I don't like to put my own numbers into here. You could do it yourself, and it designs offering memorandums, flyers, proposals, everything at a very reasonable cost. But I pay them, and they can put together from my underwriting. They can do everything for me. All this, I send it to them. It's copyrighted, and I tell them, not to give to anybody. And they just, have in total confidence. They take things from here and everything, and it all puts together into a beautiful brochure. Let me show you. They did this one. I mean, over the weekend, within 2 days, they delivered it to me. I didn't even lift a finger. Look at that. They did all that confidentiality, all this. My syndication attorney has looked over each and everything. They did all that. Beautiful package. I gave them pictures and I gave them some information, my executive summary. They put it all together. And I gave
That's
them rent.
amazing. That's great.
Isn't it great? Isn't it awesome? All that, all these pictures, all these things, they did it. I did not lift a finger. All these. Excellent. All of them. And then they put all these tables together. And then, of course, my things. Look at that. So these, they nicely took it from my worksheet and inserted it over here. All these are from my worksheet. All of these. So that's pretty good, isn't it? Right? Look
Yeah,
at that.
that's awesome.
And how much do they charge for this
I
one
paid
deal?
them, I think $250,
Mm-hmm.
$250, not bad at all. And I have a membership with them, which is $495. I think it's about the same now for the whole year. And then if you pay $495, you can design as many brochures as you want yourself on their website, or you give them, $250, they design it for you. That's how they have a great service. And then I provide them all the good data and everything. I just give them PDFs. That's all I did. So anyway, so this is where it all comes out, right? Let's just talk about, if we may, the right here is my syndication package, which is with the PPM and everything. That's a big thing. But then let's just go to Autumn Hills. That's where the rent roll is. The rent roll, the P&L, the due diligence report, all that. So I'm going to take you to the underwriting for this asset, which we just saw. Actually, we just bought two of these products, villas at Autumn Hills, 191 units, and villas at Riverside,
Mm-hmm.
total of 450. We're going to only discuss the first one. Is that okay?
Mm-hmm. Yeah.
So we take from the
Yep.
rent roll the number of total units, square footage per unit, monthly rent, what they are charging now, and this will all populate by itself. All of it. Formulas are done. So you don't have to worry about it. And then it comes to total of, make sure that all these amount to the total number. What's the average unit size? Monthly rent, what's the average? How much is the rent per square foot? Average right there. Total square feet. And then 140,000 per month rent roll to collect. And then 1.7 to 1 million for the year. Now, what I did over here, I would love to show you. Look at that. we increased the rents by about $75. See, this is monthly rent. Market rent, we found out that this property is below market. From the broker, I asked them to give me market rent study. Always, always. They have so much data, but you got to ask for it. So that gives me the upside. I call it as the upside. As we buy the property, what's the upside into it? So 171,900, and if there is a cap rate of what? Let's just say it's a 6.5 cap rate in that area. So we'll take this right there number, which is going to probably give us what? It's going to give us the value increase. 2 million. Oh my gosh.
Wow, beautiful.
Isn't that beautiful? Look at that.
Yeah, it's amazing.
It just tells you by just increasing by $75 each unit, which is going to take us a year and a half, maybe, right? So we'll be able to increase value by 2,865,000. Isn't that fabulous? It's just this small worksheet. And then I also look at the payroll. I do put a lot of things, as you can see. A supermarket. What are the positives? Fixing to explode, new business getting set up, new hotels and motels being put there, sold out hotels. You can't get hotel there. New schools being built right in the backyard of this property. The rents are lower by $75 to $150. Isn't that awesome? So more things, you can put them into this worksheet. That's going to make it a better decision, right? Okay.
Yep.
This number 1721 gets transferred automatically right over here. So that means when all of the units are occupied, 100% occupancy, this is what we're going to have. This is the same number for sellers. This is my seller side. And then this is our side. See right there. So how we will operate is here. What seller is operating at is here. And then this over here is just the information of the property. I just changed the city. Happy Lane, 123 Happy Lane, ABC City.
Beautiful. For security, right?
Yeah,
and
for
safety.
security, and then loss of lease upside automatically feeds in right from there. We just looked at it. Now, this is the mortgage section right over here. So in one page in my life, I always have believed you got to look at things in one page. Goals.
Yeah, just summarize it.
Just one page. That's it. We don't need 20 pages or 30 pages, but one page. So there it is, the mortgage. This is the closing cost and acquisition cost. Look at that here, right here. And then this is the mortgage. This is the, of course, purchase price. This is the potential upside, sorry. So let's take a look at it. 191 units. This is the strike price. Strike price, this is what actually I paid. So I'm showing you the one which I already closed on, right? But the broker told me 64 a door. But actually, when we were negotiating, they wanted 13 million. You're not going to believe it. The seller stuck his foot out and he says, oh no, it's worth a lot more, blah, 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 blah. But, I take him to task. I sit down with the broker and I found 4 fallacies in how she calculated the value. I said, you oversold the seller. You have to go back to him and let him know this is not the price he's going to get. Anyway, that's a whole different lecture, to negotiate. But then this is the strike price. But you might say, Vinney, how do we know if it says to be determined, right? To be determined by market. This was a pocket listing, by the way. So anyway, so we'll just put some number here, some number. It could be 13 million, to start with. Automatically, it's going to calculate all these things per square unit, per square. Oh, you put this one also. All the yellow places, you write it in. All the yellow places. All of these yellow places are where we write the things in. Are you with me? Right? All the yellow. And then rest of them are locked in with the formulas. Rest of them are locked in with the formulas. So that's how it is. So first we go to seller side. From their P&L, profit and loss statement, we put down each and everything. What's their physical vacancy right now? What's their concessions? How much is the loss to lease? I'm reading it on this side, right? It's the same for both the sides. So loss of lease, how much is their non-revenue units? So all these are actual numbers from the seller side. All right, right? And then
Mhm.
see, you could see that it's only like 1.9% vacant. But look over here what I did. 5% because the lender is not going to give me loan at 98% occupancy. Lender is going to take minimum of 5% or even many times 10% vacancy to calculate. So we need to do everything in our power to write down the numbers that how we're going to operate it, right? These are ours. These
Mhm.
are sellers. That's how it is. So we go all the way down to the effective gross rent right there. Now, utility income, you could see that utility 149. They have a bill back system, which is awesome. And then we have the other income, the laundry income, and pet fees and administration fee, all that stuff right there. And then these are his actual numbers. Look at that. Everything is like 38, 942, 163, 414. These are real numbers.
So you're getting those numbers from him right now, and you're just hoping that they're accurate and they're not lying
You
about anything,
got
correct?
it. You got it. I'm so glad. So you have to then justify why these numbers are there, right? So you do the due diligence, right? 21 days
Yeah.
or 30 days.
Mhm.
That's how we do it. You got it. And you go through their books, you go to their, leases, you go through their bank accounts and, contracts, their billing of the utilities, their billing of the mortgage, taxes, everything. So you have to really be a big detective to make sure that all these numbers are correct, right? you know but one thing for
Mhm.
sure, I found out they were spending so much money because the seller was actually pretty old, 73-year-old. And then they had certain, their company was not keeping the CM on top of things and all that, and they were paying a lot more for the payroll. Yeah, some other things I looked at, okay, utilities, maybe we could do a little bit less. So you massage your numbers from here. Okay, that's what I wanted to explain. These numbers are
Mhm.
sellers' numbers, but you got to massage them up or down. Okay, could be up, could be down, right? And then you put down your numbers. Now, look over the biggest difference I find is the taxes. Look over here, what they are paying tax wise and what we have to pay.
Mm-hmm.
So we have to go to the county assessor's website, find out the mill rate, and then find out what's the formula in Atlanta. This is in Atlanta, by the way. I don't mind saying that. But there, the
Mhm.
mill rate is 0.25 because this property had Lura. Usually it's zero point 0.4 times the sales price plus the mill rate. So you got to really make sure. Look, if I did not put this $66,000 more in my expenses, this number will be higher, right?
Of
Because
course.
yeah,
Yep.
and then it's going to give you wrong picture underneath. So we got to put every single number as it is going to be when we take over. Any questions? Huh? What do you think?
No, looks good. Yeah, looks
Huh?
good so far.
Question.
It's making sense.
So all these
Yeah, please.
info broker mostly provides when it's a listing, when it's professional listing. What if it's off-market listing or like direct listing where no one calculated all these expenses? What do we do in this case? If
Okay,
it's
very
That's
good point.
a
Very
great
good
question.
point. I bought 3 properties actually from an owner. No, two from one owner and one was from San Diego. And it was a bear to ask him to give me monthly rundown of the profit and loss. You got to have 3 to 6 to 12 months at least. I look for 3 years of P&L, it's called profit and loss statement, which is going to show us the total rent collected, even not the gross rent but real rent that they put in the bank, right? And then I need to know how much they're charging for utilities, if at all. Many of them don't. This number, it's a very attractive number actually. A lot of my properties I buy, this number is in the 40,000, 50,000, and I can come and install a very big utility real reimbursement program, and that will bring a lot more income. But the question what you asked me was, how about if the seller does not have it? He has it. You got to look for it. You got to push for it, because you need these real numbers. Otherwise, you don't know what to expect.
Yeah. What if one of these numbers are not true? Are they liable? Yeah.
What'd you say, please?
What if one of these numbers are not? They're not saying the truth, or not saying enough.
Yeah. Now that's a good point. Then we go rule of thumb. I'm so glad you said that. So in other words, if these numbers are way, way down, right? And you say, oh, gosh, you know what? This is not what we need to. So there is rule of thumb right there. That's my partner, Sada. Sada has written this, ROT, return on rule of thumb, 300 to 500, 600. So we put a little bit in the middle. Then this one is about 100 to 250. We put it towards the 157 range. This one is coming from here anyway. There's no rule of thumb. You just change the management fee, 4%, 5%, 6%, 7%. And then again, right? Now this one, marketing, because it's 100% occupied. In this particular case, we got 3 years or 5 years of P&L and the rent roll. This property has been occupied always 95 to 100%,
Oh, wow.
Yeah, so this is really exciting for us to see there, So otherwise, also, by the way, the rule of thumbs are over here. See, like the expenses, hour per unit, and then sellers. So all these numbers are also over here also. And then this is the rule of thumb at a glance, So answer your question, you are right. If you don't get these numbers and you feel like, oh my gosh, they are lowballing it, right? That happens a lot. They tell you very less numbers, or they don't tell you all the categories. I have come across many, many deals. They don't put all the categories. That's ridiculous, but you got to operate. You need the maximum exposure to these numbers, because all these numbers bring the NOI, the net operating income, and then they're going to bring over here the primary debt, which is the interest only. My worksheet is designed with first year interest only. I just wanted to grab that over here. See, this is the mortgage, right? 20% down, blah blah blah, all that, 5%, and all this is coming from the mortgage amortization tables. So we have all interconnected, everything. You don't have to go to any other calculator or anywhere at all. Everything populates,
Vinny, quick question. Under the expense category, you have marketing. Is that advertising the units?
Yes.
That's the annual expense that you're expecting in order to advertise all.
Yeah, about $1,000.
Okay.
They were also spending about 12,470. I just said even number. Remember, their numbers are odd numbers. All of them are actual numbers. Mine are 000. Because that's how it is, right? Yeah. And then utilities about the same. I think we can have some. I really like to educate our residents. Hey, you're paying for water, you're paying for trash, you're paying for this. So we bring some economies of scale, And the big difference was over here, where I can run the property because we manage ourselves, and I think other people can too, third party, with 1,075, per unit. That's the payroll.
Per year.
Per year. Yeah, this is per year, per unit. Yes. So 205. Now, the other part I wanted to mention was over here, the formula, it calculates annual debt service automatically with principal and interest. And this one is debt interest only debt service, for the year one. So year one, this 488 is the same as 488 here. And it's always good to always ask for first year interest only, even 2 years interest only, because you are taking over the property. Look at how much difference is there. 629,000 is with principal and interest, and this is 488.
Oh wow,
Almost
so that gives you a lot of wiggle room just because
exactly.
you're
You got it.
repositioning the property. That's awesome.
Yeah, exactly. And then the other part is the closing acquisition cost. Closing cost about 1.2%. Loan points, I put 1.75 because sometime, the loan broker charges 1% and maybe the lending institution will charge 0.75. This can all be changed. Remember, all these yellow numbers, yellow cells can be changed, you know. And then, of course, acquisition fee, usually 3 to 5%. I just always charge 4 right there. Legal cost, this is a little bit lower legal cost because we bought two properties together in one package. So for syndication attorney, I just made it half and half, another LLC structure and everything. So that's total closing cost. Capital reserves, you got to get capital reserves because we were caught really in the early years of our learning this business. We never used to collect any of this money, never, ever, to raise actually. But now we raise it. First year, 1 full year of insurance we need, property taxes, 3 to 6 months usually, utility deposits we need to transfer, and then repair allowance. We didn't need too much because this property was really good. So all this is the total acquisition cost right there, 3,600,000. Now that is what is divided over here, by the way. See, if you look at this cell, it's L33, right? Yeah, L33. Let's go here to this 12.3, put our cursor there. We are taking D38. See, whenever you are in doubt, you should just go and look at the formulas, even though we'll, get somebody to lock the formulas in, but you could see it because it's good to understand everything, right? What we are doing, why we are doing, and so forth. So cash on cash is D38. D38 is cash flow before taxes, right there, 440, 442. Divide that by this number, it's 12.3. So usually we look for 12 higher than 12% cash on cash to syndicate any deal, because you want to give maybe 8.5% preferred rate to Class A members, and then the rest 4% is for the manager, So we give them more and we take less, definitely, And then debt coverage ratio, usually it should be 1.3 or 1.4. I look for 1.6. It just says there. We say, and then cap rate 7.62. Cap rate has been compressed now, and it depends on the area, the market, everything, right, Max? Right?
Yep.
So you don't have to really, this is just a rule of thumb. Now, manager cash flow, that's our company, the syndicator, the sponsor, the person or the company that's on the loan, doing all the risk. It took them 6 months to put this whole thing together. Actually, for me, it took almost 7-8 months to buy these two after looking at 92 properties, 92. So you never give up. You never give up, and we did underwriting on 48 of them, 48. And I did best and final on four of them out of 92. So it's hard work that really brings the best in everybody's, deals. And we are so tickled about these two properties that we bought for 23 million or something, But this is 35%. I just wanted to share. This is 65, and it came to the investors getting 7.98, which is 8%. So that's what I gave my investors, 8% preferred return. But if the property does better, then they'll get more. Let's look at it here. We have some more time. This is our 5-year pro forma and budget. So this takes the numbers from the previous worksheet and then adds the different rent increases according to this percentage right over here. Whatever we tell them, it keeps on changing these numbers. Whatever we tell them over here for the vacancy, it changes numbers over here. Concession, same thing. Whatever we tell them here, it changes over here. Isn't that cool?
And they're assumptions, right? So
These
they're
are
just
all
like
assumptions.
it's your own prediction of where you think
You
this
got it. Yes.
this building will go in the next 5 years.
Yeah, that's right, And then, we are predicting it. It's good to under promise and over deliver. I believe in that 100%. That's why I've been able to give 43%, 68% per year. I mean, that's ridiculous. Some numbers that my companies have achieved, And then all these numbers right there, expenses numbers, and then it just brings it all down to here. Look at this. This is where the net, everything shows up right over here. So if I show the income minus expenses, it tells you the ratio also, that your expenses are 45% of the income collected, total rent collected, right? Total income. And then it goes down as you bring your economies of scale and everything, it goes down to 42% ratio, which is good for the investor's perspective, for your perspective. So the net operating income is 978 right there. It increases, as you see. Doesn't increase too much here because we bring lot more value in the very first year and year and a half. You know what I mean? That's why
And
you
also,
see.
isn't the interest kicks in, or
No,
nothing?
not at this level. Not at this level. This is NOI, which is the net operating income, has nothing to do with mortgage, And then look at that. Yeah, this increase is very small, very small, very small. So even though it could be growing much faster, but we don't want to, we could come across that. It might be growing better, but it's good to be conservative. That's what I was trying to say. Capital reserves per door taken out here, cash flow, after cash flow returns, debt service right over here. Take a look at. This is the interest only. This is with the principal and interest, right? Look at this. So these numbers are real numbers now. What we are looking at, year 1, year 2, year 3, year 4, year 5. And then also we give 65% to the investors to make this 8%. See, if I don't give 65, I give only 60%, this is going to be way lower number, right? So we do it for 2 years. Many of my deals, I like to give investors cash flow 65 and manager, our company keeps 35 only. But then after 3rd year onward, we do 60, 60, 60. And look at how beautiful all these percentages look right there.
Yeah, they're still going up every
There
year.
is gradual growth.
Right, exactly. So our investors will get 42%, 87, and we pay quarterly. So we pay 2, 2, 2, 2. And then at the end of 4th quarter, we reconcile and give them the higher percentage, And then this is coming from the equity. So this is all intertwined to put together, and equity comes from here. Equity return on resale. And here also we could change the formulas. What would be the cap rate on what year, all that, when we sell it, sales expense, closing costs, initial capital, principal, all these are intertwined. Every single worksheet, it's all intertwined so that it makes it so easy for you to put it in front of the investor. See, investors like simplicity, right? Because they want to, confused investors never invest with us, You want to make sure we give them the very best way and so forth. And then assumptions, these are assumptions also. The purchase price, I don't know why it didn't come here, but it should have come. Oh, there it is. There it is. I was wondering what's
Move it up.
happening. And then the acquisition expenses. Look at that here. Isn't that great? And of course, you have to work a little bit on this worksheet because most of the things come from underwriting, but some things you have to put, enter, enter, enter. We try to kind of give more. And you could even take this worksheet and even make it better, you know? I mean, that's the name of the game. And partners. Now, this is something different, which we may share it. In this worksheet, we should not share it, but we could do it with the members of the manager LLC, you know? And then we could do CapEx. We can add as many sheets. That's the best part about it because we'll only lock in the formulas in the worksheet that we provide to all our, students and all, right? This is my favorite one. Look at this one here. Very crisp, clear, easy to follow for the investors. Initial equity in this picture, we are collecting 3,600,000. Out of that, 200 is for reserves, right? Look over here. Repair and operational reserve, 200. And then these are the other costs, and these are the other costs of doing business also, right? Like 816 plus this is another. So about $1 million is our kind of cost. But when we pay to the investors, that's a very, very fine point. We have to let them know, you get paid on every dollar you give it to us. All these closing costs, acquisition fee, the insurance and this and that and reserve, all that is raised, but the investors' money, if they put 100,000, we give them on 100,000 their returns. We never take out any load. It's called load, right? Or discount. Like, hey, if you put 100, about 5,000 is going towards the expenses. Not at all. We give them returns on every dollar. And then we
Beautiful.
give them back. Is that okay? Yeah. So that is what they are making. This is the percentage up on the top, for the whole, all the investors get this much money each year and total is this much. That comes out to 42.87. All these are done, intertwined. You never have to lift a finger. It's all done for you. And then equity gain will come automatically here. It will calculate all these. It will calculate all these over here and then put down all these things for you. Everything is all done. So in other words, actually total projected return, this I have a question on because I added C13, which is the initial capital. So I'm going to take that off because it just does not give good, what it was that we do return $100,000 initial investment, plus they get a total return of 100,000 on top of it, which is split into cash flow 42,871 and a check on sale for 57,231. Right? So this is the check. They get one check for 100,000 back in 4 years, 5 years, whatever, when we sell it. And then they get another equity gain check, long-term equity gain check of 57,231. So the total they will average per year, average annual cash flow and equity return per year, right, of 20%, little over 20%, they will be able to make.
Incredible.
Isn't that great? Isn't that awesome, guys?
That's
really awesome.
This what will sell any investor. Yeah, this graph.
Totally. And
but you got to keep in mind those are projected numbers, right?
These are projected, yeah. And we write it. And we write it everywhere. See, this summary does not purport to be complete and will be supplemented with additional information at such time as it is requested with an interested investor. This use of this material is authorized only for those to whom it's originally provided. This is not an offer or a security. An offer can only be made through the complete private placement memorandum. So we try to put everywhere And even here,
Mhm.
depending on the closing, there might be 1 or 2 months of cash flow returns additional to this. The rates of return displayed on this page are only projections and are
Yeah.
not guarantees of any sort.
Mm-hmm.
Actual returns may vary widely due to many economic and marketplace factors beyond our control. So all
Mhm.
these
Yeah.
things are well written and seen by my syndication attorney.
Mm-hmm.
Everything I do, I have two real estate attorneys, right? One is Milton Colgrove, wonderful person, very good friend of mine for 10 years. And then Kim Taylor, my syndication attorney. Now I have third one, Shola in Georgia. So every state we go to will find, the new attorney. And then my master attorney on the top, Milton is always on the top in my organization. He looks through all my contracts. He advises me and counsels me. And I love that. I really love that because, you want to build a very strong company and you can only do that if you have right people on our team, right?
Yep.
Yeah. So what questions can I answer? We got, a little bit time. So do you like it?
This
Yeah,
is
yeah. It
deep.
seems like a really, really formula heavy spreadsheet.
Yes.
But that's awesome. That's awesome. That just goes to show the importance of really doing your research and digging through all the files and making sure you can
Yes.
crunch some of these numbers, because if you input the wrong numbers, that could mess up all of the formulas and give you inaccurate information and
Exactly.
projections on the property. So I feel like,
Right.
that's definitely an amazing skill to have, is to be able to go and do the background check and be able to find the real numbers, not only what the seller might be giving you.
That is
Mhm.
true, Max, what you just said. But see, the thing is, we don't start due diligence. We cannot put our foot on the property unless we have done all this and we look through the area, the police report, the economic report. We had somebody nearby that property to go there and take 150 pictures, something like that. So a lot of the information goes on before even we do this underwriting. We need to like the neighborhood. We need to like the structure. We need to see if it's a pocket listing or is it never from LoopNet. Well, sometimes you get from LoopNet, good picture, good thing, but not much that much. But the biggest thing is the rent comparison study. I mean, and asking the broker, hey, why should I invest in it? Can you send me lots of data on the economic growth in that area? That's what I did, by the way. I never knew which this city is when I went to Atlanta. But this I bought in 1 year, 1 hour, not 1 year, 1 hour, because I bought another property. That's why I went there for 267 units. And the broker said, Vinny, do you have some time? Can you get in my truck? And then he took me to this one. I loved it. I just totally loved it. Such beautiful all brick, building and nothing to do. The staff was really into their uniforms, all that stuff. So I just loved it. And I said, let me crunch my numbers with me and my partners, and then we'll be able to buy tomorrow. And that's what we did. We bought it the next day. So, no, go
That's
ahead.
awesome.
Yeah. But you're right. I mean, you got to be the most, to the nth degree detective, because once you buy the property, it's yours. I mean, once you did the LOI, the contract, and then the lending loan and everything, and you took over, this is now you are married with that property, whether it's good or bad, for at least 3 to 5 years, right? Unless you're repositioning it. So it's very, very big, that way. But let's just go ahead and just if you would like to say any comments, we'll wrap up this
Uh,
session. Hmm?
Vinny, a few questions. So where do we see managing fee, or what if our management company is third party?
Yes,
Is
right over
will
here. Right over here, Elijah. It says management percentage. So if they charge you 5%, you put 5. If you are
okay.
like in our company, we manage ourselves. So we are able to cut down the fee to 4%, and sometimes it's 5, sometimes it's 6%, but you got to look at that, right? So the taxes mill rate and the management percentage and then the capital reserve are the three things we could change over here, and then we could change these yellow, which is utility reimbursement and other income that you can change here. And then, of course, secondary debt, if you have a second supplemental loan, we could change that in here. And then this percentage, how much we keep for our general partner, or we give to the, this is automatically done, but the yellow one, we can change there. First year insurance, if you have to raise 100%, we could change it here. It calculates it. We have to put our own money on the utilities and the repairs, yellow, which is legal costs, yellow. Acquisition fee, you could change it to 3% or 2%, right? You could do all that. And then this closing cost, you could change that. You could change the loan points, could be only 1%, In my case, I have a loan broker, and in between, and actually I got a Fannie Mae loan. I don't think I had to pay 1% at all. So I like to put more numbers here so that at the time of closing, to be conservative. You got it. And
Vinney, then, for cash flow, again, for cash flow, you said 35 and 65. Does the manager's cash flow, is this yours or the management company, or how does it?
Okay. No. Management company. See, in my case, I own the management company. So that 4% goes to my management company and their employees to run that management company, to oversee the asset. But this at the bottom, 35% is the manager, which is Monil Investment Group, which I'm the CEO of. So that is what is the manager LLC gets.
So in other words, as a syndicator, you get this commission, 35%, and then closing cost or acquisition fee.
Acquisition fee, right here, 4% acquisition fee. I get the day of closing, which I got, right? At the day of closing, this much I made, and then I will make every year about 154,000, right? Or if we go to 5-year projection, it will show us, I'll make first year this much, second year this much, third year, my investors will make this much. And then they will also make the equity gain, at the end of this much, which of course, a portion of that, from the larger, which I can go here, equity gain or resale. So actually right over here is the breakdown, manager share of the equity gain, which is from year 2 to 5 is 40%. Equity gain is always 40%. So we'll make about, this much. If we sell on the 5th year, my, manager, the syndicator will make 1,373,000 and the investors will make 2,060,000. So that's how that is all broken down, But the thing is, for people starting out, you will be able to finagle these numbers and make them less or more depending on how you want to do it, right? So this could be actually yellow color, to be truthful. Oh my gosh, it's a little too bright for me. Okay, right there, But, so all this comes together. And thank you so much for joining with me today, Elijah and Max. And we'll start the mastermind right after this one. Thank you.
Wonderful. Thank you, Vinney.
Thank you so much. Thank you so much.
We just saved $160,000.
Yes. All righty. We'll join the mastermind right after this. Thank you.
All right. Have a good one. See ya.
Good year.
Bye-bye.
Bye.